going into the election, it would not surprise me now to see a bit more of a market decline here. It could kind of just grind sideways or potentially a little bit lower here to around, potentially 5,700, 5,750 on the S&P. Wouldn't be surprising just to kind of get ahead of the election. And then we'll see what happens. But again, I think there's enough potential election risk out there that we may see some managers just kind of be a little bit more cautious here over the next couple of weeks.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week for another weekly market recap featuring my good friend, the transcendental Lance Roberts. Lance, how you doing?
Yes, we are meditating today.
Yeah, I don't necessarily mean transcendental meditation, but I'm, as you can see, everybody, I'm not in my studio. I'm in Concord, Massachusetts, which is the birthplace of the shot heard around the world that kicked off the American Revolution. And Lance, if there's time at the end, maybe we can talk a little bit about that. Pretty fascinating,
Sure.
The history that you get to learn here. But it is also the home of the Transcendentalists. So Ralph Waldo Emerson, Henry David Thoreau, Louisa May Alcott, Nathaniel Hawthorne. In fact, they're all buried on the same little plot, like the same little hill in a cemetery that's about a half mile from where I'm staying right now. So anyways, I thought that was good company to mention you in.
What, dead people? Thanks.
Yeah, well, smart dead people.
I am feeling older these days, but there you go.
Well, they've got a little space there reserved for you. So probably won't take that long, it sounds like.
So have you actually been out to the battlefields and all that around, around that area, back from the Civil War and all that?
Yeah,
and the Revolution.
War. Yeah, although there are Civil War memorials here too, those that served in it. Yes and no. So I haven't been to Northbridge yet, which is where the first shot was fired.
Right.
Just because I haven't had time yet. I hope to hit it on my way out of town. But yesterday, I'm here for an event with the guys from New Harbor, with their clients. Really fantastic experience. And after the conference, we had a walking tour of downtown Concord. We got to go into the tavern where the colonials were like basically decided, you know what, we've got to build our own militia. And they started stockpiling really an amazing amount of material for just a bunch of, sort of small towns with farmers. And then the British got a whiff of that, and they sent a regiment out here to basically just, as peacefully as possible, just take all the stuff that they knew the colonists were stockpiling here. And of course, the colonists didn't want to let that happen. And that's where the first real conflagration started. And then history happened. And it's amazing. And again, this is sort of the rant I want to have with you at the end of this, not a rant, but a fun discussion about two things. One, how oftentimes in history, a very small number of people tip the scales of history, right? And then secondly, usually during those events, there are so many moments where history could have gone a different way, like so many different failure points. And oftentimes, maybe just one person did the key thing at the key time. And, that eventually kept the thread going until the eventual outcome. So, I mean, there were so many times, even just during that British march here to Concord, where it could have been over in a heartbeat, right?
Yeah. Well, no, and what's fascinating to me is that, when I was growing up, my dad was a huge history buff, which, obviously is why I'm a huge history buff too. But, when we were growing up, we drove everywhere. So, we drove up, to New England and went to all the different, kind of the historic sites where, the revolution was fought, et cetera. And you go into some of these, outposts and some of these little areas where they were shacked up, and you realize that these people were all short. They were all like 5'3" to 5'6", right? They were very small people, and so when you talk about a very small group of people changing history, yeah, they were small.
They were literally small. Yeah. So as you know, I'm from New England, from tiny little fishing towns.
Yeah.
A lot of the homes there are built in the 1700s. A lot of my friends grew up in them, and you realize, people both were a lot smaller, but also just had a different sense of personal space. They were comfortable living a lot more cramped together than we are. Certainly you Texans there with your, gargantuan homes for, two people.
Hey now.
All right. Well, look, lots to talk about and not a ton of time, folks. This one might little shorter than normal. So we may want to get to just the chart of the S&P and see what the TA is telling us. I've been kind of heads down the past couple of days, but Lance, you were just telling me as we were getting ready to talk here, it sounds like, if I heard you correctly, that a short-term sell signal just got triggered.
Yeah, well, so you got to keep this in mind, because last week we talked about, hey, we've got our seasonal buy signal that's in. That's a weekly chart. So last week we discussed the seasonal buy signal. We got, and again, we talked about the seasonally strong period. I wrote an article about this. By the way, just wanted to thank everybody. I was teasing Adam a lot last week because Adam had, put out an ad with my picture on Twitter, wanting to beat me on the number of Twitter subscribers. So I'd ask you to say, hey, go to Substack and sign up. Lots of you did. I really appreciate it very much. It's awesome. We're trying to build out that channel. We're going to kind of move most of our kind of our higher content reading stuff over to Substack, because we're launching a new website in the next 2 weeks for real investment advice, which will be kind of more commercial in nature. So we'll move a lot of our research platform over to Substack. So I do appreciate you following us over there. But I posted this article on Substack talking about the seasonal buy signal. And so if you haven't read it yet, I encourage you to go read it. Now, that's using weekly analysis. And what history tells us is that the period from November to basically May for the S&P 500, that 6 months, is where the vast majority of returns come from the market historically. Now, during the summer months, there are certainly summers that you have very strong years, but on average, the summer months from basically May to October tend to be much weaker in terms of returns. It doesn't mean negative, but the return differential in terms of compounding of returns over time is vastly weighed to the benefit of the seasonally strong period. So we use a weekly signal to tell us when that period starts. So that started on October the 11th. Now, in the short term, the markets have just been on a tear for the last 6 weeks. And we've talked about the fact that over the last 6 weeks, which is, by the way, we had 6 straight up weeks, as we talked about, I think, last week. That's a very long stretch without a break. The markets just, the markets can simply not go up every single week. It's just physically impossible for that to happen. You're eventually going to have somebody that says, I've made enough money here. I need to get some money off the table, take some profits. And that happened this past week. We've talked about just recently that this very long stretch of returns was occurring on weaker momentum, weaker relative strength, and that typically precedes short-term corrections. And that's what we saw this past week. So, this is where I know it gets confusing, because we talk, I'll be on here with Adam. And again, you get to visit with us once a week here on the show with Adam, and it's great, but you kind of miss what happens between these Saturday events that go on with the markets. But this is why we post our daily market commentary, which we also post to Substack. So again, if you're following us over there, you'll get our daily market commentary every day. And we update you literally every day about what's going on with the markets. And and we tell you, hey, look, markets are really stretched here. Take a little bit of money off the table. Markets oversold here. You can put some money to work. The trend of the market remains very bullish. There's nothing wrong with the market. There's, earnings are continuing to come in very strong. We're beating estimates right now. So there's a lot of underlying support. Today, Adam and I are visiting on Friday morning. It's very early. The market hasn't even opened yet. But by the time you're watching this, the blackout window for corporate share buybacks will be starting to reopen, and will be fully open in about another week and a half. So corporate share buybacks are about to start as well, which provides a support for the market. So again, going into the end of the year, there's really not much to deter the market to any great degree. Now, it doesn't mean we can't have a correction. We talked about this last week, that even though we had a seasonal buy signal, the markets were very overbought, very stretched, and we would probably get some type of little correction here before the election. Just if you think about it from a portfolio management standpoint, let's just say I'm a hedge fund manager, or I'm a big professional investment manager of some sort, and I have billions of dollars under management, and I've been placing a lot of trades, and that's what we've seen lately is that if you take a look at what Wall Street is suggesting about the outcome of the election, they've been piling into trades over the last really 3-4 weeks that would benefit from Trump's policies more than Kamala Harris's policies. So the market's kind of placing a bet that Donald Trump will win the upcoming election. However, we don't know that. Nobody knows that for sure. We do not know how this election is going to turn out, but we were placing some bets on that. Not we. Again, I'm talking about ubiquitous portfolio managers, not me personally. We were placing bets on this as portfolio managers, and we've made a bunch of money over the last few weeks. It's just been kind of a very nice ride. And going into the election, I don't want to necessarily give up all those gains. What would happen if everybody's invested into Trump-related trades, as an example? So financials, energy, more drilling, financials, deregulation, energy, of course, because of opening up more drilling, technology because of onshoring and Chinese tariffs. Those have been the trades that have been working very well. Well, what would happen if I woke up November the 6th and Harris was president? All those, I would have immediately have to unwind all those trades and then move to a whole new basket, right? So it's not surprising you're going to see a little bit of selling here before the election actually occurs, just to take some profits and hedge my risk a bit going into an unknown outcome. The other outcome of this is, of course, is that we may not know the results of the election for a week or two. If it gets contested, I mean, lawyers are already lining up right now.
I hope you're wrong. I certainly hope you're wrong, but you could be right.
No, we're already hearing multiple reports from states that it's going to take them 4 days to get results counted, which is ridiculous. We should know the results. Considering we have computerized balloting and all this type of stuff, we should know the results of the election literally within 24 hours. The fact that that states are already talking about 4 days is ridiculous. But there's already states saying, hey, we're not going to know the outcome for 4 days. Okay, whatever. But then if the contest is contested, and lawyers are already lining up to file lawsuits, so it doesn't matter on what side. It kind of fascinates me. They say, well, if Donald Trump loses, he's going to contest the election. Democrats are going to do exactly the same thing. So no matter who wins or loses, somebody's going to contest the outcome of the election. So it really doesn't matter who wins this election. There's a very high probability that this contest will be contested until December. So we may not know the actual outcome of the election until December. That could potentially throw the markets into all kinds of turmoil because they just simply don't know how to invest for about a month and a half.
Right. So safe move is take the gains off the table for the election. Yeah.
Right. And so because of that, we had enough selling this past week now let me kind of share a chart with you. This is the S&P 500. And again, we kind of watch this MACD signal. And it's interesting. The market kind of peaked back in late September. We got a sell signal. Market sold off a bit, then kind of hit the bottom of this rising trend line that we've had really since the August lows. This August low period right here was the yen carry trade blow up, and that was where everybody was like, "Oh, the market's done now." And then we've just rallied, kind of rallied right back since then. But this compression of price is called a rising wedge. And eventually at some point, it's like a coiled spring. So the more you compress that wedge, the more powerful the move will be in one direction or the other. So if you break out to the upside, in theory, it moves fairly sharply higher. If you break to the downside, you're going to get a correction back to moving average support. But you can see this kind of shaded area in the back. Let me zoom in here, but this kind of shaded area in the back is volume on an average weighted basis. And what you'll notice is that as the markets were rallying, that volume was declining. So we had less participation in the markets. Relative strength, you can see here that relative strength actually kind of peaked back in July. We've had lower levels of relative strength in the market. This is called a negative divergence. So, and also the same thing with the MACD even, which is a measure of momentum because it measures moving averages. That's also had a negative divergence as well. So as the market was rising, you had this negative divergence in momentum and relative strength, which does suggest some caution for investors. And that's why we kind of continue to continued to kind of suggest that when markets have rallied to the top of this rising trend line, take some profits, kind of, rebalance your risk a bit. Again, it doesn't mean sell everything. That's never the case. And then when you get to kind of a short-term oversold condition, you get a buy signal, you can add some money in. And, we're just, going into the election, it would not surprise me now to see a bit more of a market decline here. It could kind of just grind sideways or potentially a little bit lower here, to around, potentially 5,700, 5,750 on the S&P. Wouldn't be surprising, just to kind of get ahead of the election. And then we'll see what happens. But again, I think there's enough potential election risk out there that we may see some managers just kind of be a little bit more cautious here over the next couple of weeks.
Okay. So we can't even call this a correction yet. It's not a correction at all yet.
Pullback.
We've seen a trend line break here.
Yeah.
Which leads you to say, hey, for both technical reasons as well as the proximity of the election, wouldn't surprise you to see things pull back a little bit further here and then move on again once the election's over and hopefully the dust is settled.
Right.
Let me just ask you this: so in previous weekly recaps, you've said the runway looks pretty good through the rest of the year post-election. For stocks to end strong, and you're not the only one on the channel who said that. We've heard that from a whole bunch of people: Jim Carson, Darius Dale, Michael Howell, and we're close enough now where I think the mental tractor beam of S&P 6,000, is starting to lock in. Where the closer you get, just psychologically, people begin to think it's just going to be a fait accompli, right? And it kind of becomes a self-fulfilling prophecy. So do you think that, odds aren't bad that we could be at 6,000 or maybe even a little above by the end of the year?
Yeah, that's our target right now. Our target for year end is 6,000, and we're on the low side of that. And the only reason that we're at 6,000, if you take a look at Goldman, JP Morgan, others, they're around 6,300 by the end of the year. We're at 6,000, and only because we expect a bit of a correction and then a rally into year end. So you've only got 2 months basically left. So you got November and December. October is almost done. So you get a bit of a pullback in theory to about the 15th of November, somewhere in there. We get and this is all assuming we just kind of get through the election and everything's okay. And then, of course, you've got 3 factors to drive the markets into year end, which is corporate buybacks, which will be $6 billion a day on average. You've got a lot of managers that are trailing performance this year in terms of their benchmark. So there's going to be a lot of push to both get the right positions on their books as well as chase performance into year end. And then you've got retail investors, which also have moved into a much more speculative mood over the course of the last few months. We're seeing money flow out of ETFs and into individual stocks. So, what they say about bull markets is that bull markets make geniuses out of everybody. So now retail investors are beginning to get very confident about their ability to manage this market. So now they're starting to say, well, I don't want to own just an index ETF and get an average return. I want to try to beat the index. So I've got to own individual stocks. And they're starting to, of course, pile into some of the more speculative names in the markets and chase. We've seen meme stocks perform very well as of late. We've seen companies with the poorest quality fundamentals perform very well as late. And then that's not surprising when you have a very bullish outcome. But again, you can't really, tell them that they're wrong. Again, you grabbed the screen. I was just going to share this one chart with you very quickly. No, it's okay. And I thought you'd already grabbed it anyway, so it's no big deal. But this is the return of the market this year. This is the best return in a market since 1999, which is pretty phenomenal.
So I think I know why you're pulling this up for a market return, but doesn't that say year-to-date performance?
It does. I'm sorry, I grabbed the wrong chart. It's the same thing. Yeah, apologies. I grabbed the wrong chart, but it's exactly the same thing for the S&P. This is the best return year I was doing some work on gold this morning. But yeah, this is the best return year for the market since 1999. And that is even better than that massive run that we had in 2021 when you had $5 trillion worth of stimulus going directly to households, and everybody, they couldn't gamble, so they all turned to Robinhood and started gambling on stocks. And we had that monster year in 2021. So it's pretty amazing that despite the fact that we don't have stimulus going to households, we don't have government, doing massive, debt-driven programs right now, like the CHIPS Act and like the Inflation Reduction Act. We're at the tail end of those, but we don't have any new ones. And yet we just have these massive inflows of foreign capital into U.S. assets. It's just been quite a phenomenal year for markets. And, it's just we're like we're the prettiest girl at the dance right now. Everybody wants to have their money in U.S. markets.
So, I was at this investor conference yesterday, and, there was discussion of like, hey, like anybody looking around can see that like the U.S. consumer isn't doing that great. And, where's the money coming from? So we're talking about the fact that stocks could continue to power higher from here. And, there's just some head scratching on like, well, where's that going to come from? Because the average American isn't doing very well. And of course, it's multifactorial. But a big part of the explanation was, yeah, that very well may be true, but a lot of other people in the world that aren't in America who want their money here. And there's this, just big tailwind of foreign capital flowing into the markets right now, right?
Yeah.
Capital goes where it's best treated. U.S. markets are throwing a party. Everybody around the world wants to be in that party.
No, look, it's, we see that, we hear these headlines, right, about how poor the average American is doing. We have to remember that the average American doesn't invest in the markets. They spend literally everything they make buying stuff.
Right. Just to be clear, because I think it's a really important distinction. The median American not doing well, right? Average American actually still doing okay, but it's because the super rich are pulling everybody up. And as I say often, that's important to understand the distinction here. But you're right. I mean, again, you look at the median American, they probably don't own any stocks.
Yeah, they don't. I mean, we know that we know the facts. We can pull the data that the top 10% of Americans own about 90% of the stock market, give or take.
Yep.
But there was a great statistic. I saw this really great research report from Bank of America. I think it was earlier this week, but they were talking about that that out of the families that make $150,000 or more a year, about 20% of them live paycheck to paycheck. Now, we want to blame that on inflation. We'll say, well, see, that's because of inflation. That's not really true. That stat has been that way for a very long time. The reality is that most people are just terrible with money and they spend more than they make. I can't tell you how many people that I visit with. You would be shocked that the number of people I visit with that have a few $1 million in the bank, they make $1 million a year. And if something goes wrong, they're filing bankruptcy in a month.
Yeah.
Because they spend everything on houses and cars and boats, and they live an awesome life. They live the Instagram lifestyle, right? I mean, you go hang out with them. I mean, you're just kind of,
you can have a fun time. Yeah.
Yeah. I mean, it's like I wish I could live this way, but you don't realize that behind the scene, they are just paddling like a duck underwater, trying to stay afloat. But that's just because so many Americans are just so bad with money. They live way beyond their means. They don't save. They don't invest. And, and I love all these things that we see on TikTok and Instagram about, oh, you can go out and do this and make money and all this. And you got to remember, they're making their money by posting the content that you're watching that they get paid for by Instagram. And that's how they're making their living, not necessarily by doing what they say they're doing to make money. So just be really cautious with that. But there's no doubt that the markets are doing well. And to your point, the amount of money flowing into the U.S., the U.S. stock market makes up 60% of the global market cap. So you can talk all day long about emerging markets and international markets, but at the end of the day, it's the U.S. market that drives the ship.
Okay. So there were some really interesting points that were brought up yesterday that I want to kind of try to pull into this conversation. Because I love these in-person meetings with thoughtful money viewers. One, first and foremost, because the people are just so awesome, and it's really fun to spend time with just really nice, curious-minded, thoughtful people. But also, it really gives me a much closer sense of the pulse of what are the issues that people really care about. What are they thinking about? and probably even more at an emotional level, like what's driving people emotionally. And one of the things that came up was, people are really beginning to watch the bond yields now and beginning to say, hey, they're getting pretty high now. Like, is this a sign of trouble? Right? Is this more than just, cyclicality that bond yields go up, bond yields go down? Or is this a sign that the bond market really is trying to send a message here? I know that you have a strong opinion on this, Lance, and I want you to be able to give your latest on it. But I do just want to note that it's like, I mean, and it's understandable, right? It's like bond yields are bucking the trend, especially because the Fed has started cutting. Right. And you and I have talked a long time that, the Fed doesn't control the long end of the yield curve. But I think conventional wisdom, rightly or wrongly, assumes that if the Fed announces that it's going into an easing cycle and it's starting to bring down rates on the short term, and it starts with a big salvo of a big 50 basis point cut, that, long-term rates will likely follow a similar trajectory over time. But right now, the 10-year has really gone in a direction people didn't expect. Mortgage rates have continued to rise. So let me let you speak to that emotional question that people have.
Yeah, no, and again, look, it's a fair question, and when it's always interesting to me that whenever rates go up, that it's like immediately you start getting comments out, in the media and everywhere else is like, see, inflation's coming back, and see, this is because of the debt, and see, this is because of whatever it is. Not really. Here, I'll share this with you. But so back on September the 17th, if this date is important to you, we wrote the following. With the Fed meeting this week, the current setup suggests that even if the Fed cuts as expected, this could be a buy the rumor, sell the news setup for bonds. Of course, this is always the case. Overbought conditions can remain overbought longer than most imagine, so trade accordingly. Our point was then is that bonds were trading extremely deviated above their long-term means. We'd had a monster rally in rates going into that first Fed meeting. So again, as we talked about before, you just literally got everybody onto one side of the boat. Everybody was banking on bonds and the Fed cutting rates. And so when they cut rates, immediately that was that kind of that buy the rumor, sell the news thing. And so you've had a correction in bonds. Now bonds are extremely oversold. So now, and so two things feed into yields, which is one is inflation expectations, and two is positioning. And everybody had been positioned on one side of the boat for that first Fed rate cut. So when you started the reversal, that created that sell-off in bonds. And then again, we have to rationalize that as investors. So instead of just looking at price action, we have to come up with these excuses of, oh, well, it's because of this or because of that, or thing. It has nothing to do with any of that. It's simply just a reversal of positioning. But secondly, though, is that we had economists extremely negative on economic growth for this year. And so then, of course, right after the Fed cut rates, we had a really strong employment report. We had better than expected economic report. We had better than expected retail sales report, which pushed the economic surprise index up. Again, if you take a look at where economic surprise was, it was very low. And if you don't understand the economic surprise index, it is what it sounds like. It's basically economists are being surprised by the data. And all the economic surprise index is that it just tells you how wrong economists are at one given point or another. And so the economists had gotten very bearish on the economic data. So when the data started coming in slightly better than expectations, which is all it was, the surprise index went up, and yields track economic surprise. Now, economic surprise index is very elevated. Economists are very bullish about economic growth again. So now we're about to start a reversal of that process. Economic data will come in weaker, yields will start to fall again, and then we'll be back on the other side of the equation here fairly shortly. But again, it's not surprising at all that we had this rundown in rates. In fact, just on Tuesday, in my personal trading account, I tell y'all what I do personally. Now, I did not do this for client accounts. I wrote this up in our daily market commentary. So again, if you read our daily market commentary, we keep you up to date on kind of everything that we're doing. But let me see if I can I want to bring it up for you so you can see it. Yeah, here it is. So this is some basic analysis that we did on Tuesday, talking about this specific trade. And as I note in here, it says, so why did we do this for our client accounts? Great question. The reason is the clients that we work with, we manage capital for retirement. So I don't speculate with client capital. I don't take that kind of risk with client capital ever, because they're dependent on it. Second thing is they already have decent enough bond exposure right now. So when rates come back down, they're going to do fine. And at some point we will add to our bond duration. We're just waiting for the right trigger for that. And then C, of course, again, this is my personal account. So if I lose money, I don't care. It's my money. Personally, I just can't, just from my own personal position, I've never lost a massive amount of money for clients, and I'll never put them in a position where they will do that. So having said that, if you take a look at this chart, which is the 10-year treasury, what you're going to see is that the 10-year treasury is now over 3 standard deviations oversold. Now you'll notice that we were 3 standard deviations overbought before we had this big correction in rates. Relative strength was extremely elevated before we had this correction. The MACD signal was extremely elevated before we had this correction in bonds. So again, just technically, this correction was very likely to happen. And this is why we wrote back on 17th of September, this is a buy the rumor, sell the news event. It has nothing to do with the economics. It's all about positioning. In the short term, it's all about positioning. In the long term, it's inflation, wages, and economic growth. That's what drives rates. So now with bonds extremely oversold, I added to my long bond position in my portfolio, and I bought call options for the end of the year, in the money call options on TLT for a December maturity. So I think post-election, and then also too, this positioning in bonds is also kind of part of this election trade. Again, when everybody wants to be in equities, I don't want to be in bonds. So I sell bonds to buy equities. I go from risk off to risk on. So I think after the election, particularly if we have a contest of any sort, we'll see a risk off rotation out of equities back into bonds for a safety trade.
Okay. All right. So in your mind, this is mostly just it's a story of the rubber band. It
Always.
was really stretched one way. It is now snapped back, now very almost equally stretched the other way. And so much so that while you're not doing it in client accounts, your own personal account, you said, I'm going to put some money on this thing, normalizing as the rest of the year goes on. Okay, good. I think that helps ground people that were worried about this. And I'm not just because there's more things to talk about. I'm not going to ask you to kind of rehash your longer term strategy on the bond trade and where you think things are likely headed next year. But I just want to note that, folks, if you didn't watch our Fall Online conference this past weekend, Michael Leibowitz in his segment there basically just did a full refresh on, hey, this is where we think bond yields are headed and bond prices headed, and basically saying, yeah, rates are a little elevated right now. I'm not worried at all. Which is he basically gave the fundamental answer to the technical one that you just gave.
Yeah, I'm sure Lacey Hunt also said the same thing for the most part.
Yeah, I mean, I would say Michael looks like an optimist compared to Lacey Hunt in terms of the macro factors that will likely push yields down. Okay, so related to this, though, so another speaker at the conference who folks really enjoyed is Stephen Bavaria, and he's the fellow who focuses on income investing. He has his own framework. He calls it building an income factory. I think we've talked about him a couple of times before, Lance. Mm-hmm. But right now, these higher yields if you like the income factory approach, if you like building a portfolio for income, pretty good time in the near term to be doing that, right? If you're right, Lance, right, and these things do normalize, this is a really good time to get in at attractive prices, right, and get a higher yield to maturity on the assets that you're adding to your portfolio.
Right. Yeah. And if you're, and again, this is the thing that people don't understand about bonds is that if I own a bond, it doesn't, look, and again, people say this all the time, so I can just get 5% of my money or 4%, whatever it is. I'm good. I just need 4% of my money. Okay, great. So go buy a 10-year, you go buy a 20-year treasury. You can lock in about 4.1, 4.2% right now on a 20-year treasury. And it doesn't matter if interest rates go to the moon and inflation skyrockets, you're going to crank out 4.2% a year and you get all your money back at maturity. So And that's the great thing about bonds. And that's why, having bonds in a portfolio is so incredibly important, because it lowers portfolio volatility, it protects capital, and and we talked about this last week, you and I did on the show, talking about how to build a 6% rate of return in your portfolio. And we kind of went through the allocation analysis of what bonds provide is, and especially today, if I'm trying to get 6% out of my portfolio every year, I don't have to work real hard. I build a dividend equity portfolio that yields, 3.5%, 4%, which is very easy to do right now. I buy fixed income that's cranking out, 4.25%. And then I only have to get 1-2% growth out of my equities to get to my 6% rate of return. I've got to take very little risk for that. And I can create a very low volatility portfolio that will generate my financial returns over time. But see, we get so wrapped up in these headlines about, oh my gosh, inflation's going to do this, or the economy is going to do Y. And I heard a terrible analysis from Paul Tudor Jones this past week. I got like 50 people emailed to me about why interest rates are going higher, and he compares it to Japan, which there's absolutely no evidence that thesis holds any water whatsoever. If you just take a look at Japan's debt to GDP and their inflation rate and interest rates, I mean, so they're basically at zero and going nowhere. So, kind of all these, fear-mongering tactics to get you to buy an asset or to scare you into some methodology. Just step back and take a look at what are you trying to achieve in your portfolio, and build a portfolio to deliver that. And just be aware that all assets have risk, whether you own gold or whether you own stocks or whether you own bonds, there's risk to all of it. And that's why we manage risk. You can't just buy an asset, sit on it, and expect it to do something over a 30-year period without having, very large bouts of volatility along the way, particularly in today's environment.
Yeah. And just to your point about how, relatively easy right now to build a portfolio that'll yield, what you need to get to your 6%, or, whatever your hopefully reasonable goal is, right? You're not You're demanding your portfolio return 15%, every year. But and Stephen was saying, especially in this environment right now, on the credit side of things, so theoretically less risk than the equity side of things, you can actually get a higher, returns somewhere between 6 and 9% or whatever by, at sprinkling in a little, preferred stock, a little, high yield debt, a little master limited partnerships, some business development, like a lot of these assets that are returning higher than a treasury bond, but still are largely debt instruments. So they're contracts. They don't have the enterprise risk that a company does, like an equity does. And if the company gets in trouble, they've got seniority over the equity holders, so you're first in line. It just basically ways to build above a 4% return with a higher degree of safety than an equity.
Right. Well, but again, you got to be super cautious about
that. You do. I'm not trying to make it sound like it's super easy, but you can build a diversified portfolio that returns,
Because right, you can, and again, that's absolutely true. Like, for instance, in our dividend equity model, we have some holdings that are cranking out 10, 11, 12% on annual dividend yield. However, the mistake that investors will make, and this is what always happens, two things happen with that type of structure. Actually, three things. So it's a great sounding idea when you're in a bull market, right? I can buy these assets with high yields. There's a reason they pay out high yields to start with, which is they're not risk-free. The higher the yield you get above market yield, the more risk you're taking. So when you talk about high yield debt,
with any asset, yeah,
exactly. So when you're talking about high yield debt, that's a nice Wall Street marketing term, because they couldn't sell you junk bonds, so they call it high yield. But I'm not saying there's anything wrong with them at all. I'm not saying that at all. Just understand what you're buying, because if we get into a market correction where the markets are down 30, 40% at some point because we have some type of financial issue, you're going to lose 60 to 70% of your money when that occurs. Go take a look at preferred stocks back in 2008. They did worse than the financial market itself. High yield debt, a lot of them went bankrupt. MLPs got absolutely decimated. A lot of the companies that were in the MLPs went out of business. So understand that there's a vast amount of capital risk building a portfolio that's above average rates of returns. This is why, again, we go back to risk management. Why do we pay so much attention to technicals? Why do we pay so much attention to the underlying fundamentals and what drives these particular rates of return? Because we have to get out of these positions ahead of whatever the event is going to be. But that could be years from now. I mean, you could build an income quote on factory portfolio. We do the same thing. You can build that, and it may work great for 3 or 4 or 5 years, maybe longer. And then 1 year, you're going to lose 10 years worth of gains. And then that's going to be the issue.
Can be. And so a couple of things you said, I want to make sure are really clear. So like Stephen, and I'm not trying to plug Stephen's services here,
Right.
but I think he's a good guy. Stephen has a newsletter where he basically shares his trades. And so if you want to look over his shoulder and copy what he does, you can do that. And that's great for a very DIY person who wants to do that, right? I think I just heard you say, hey, if you like the idea of an income generating portfolio and want to build your own income factory, but you don't want to do it, sounds like RIA can do that for you.
Right.
Correct? Right. Okay. Yeah. So people that want a quarterback to do that for them, they can talk to a firm like yours. Also, I'm getting here to a piece that you just released, which we've talked about a bit before, but given, the higher valuations get stretched, right? The higher multiples go, you are essentially pulling tomorrow's returns into today, right? And so the higher valuations go, the more you have to ratchet down your return expectations for coming years, which is why I think, correct me if you think differently, building the type of portfolio we're talking about here right now actually maybe especially makes sense in this type of stretch valuation environment, because if we expect there to be substandard returns going forward, you can kind of lock in, a predictable return with some of these instruments that we're talking about. Is that correct?
But again, you have to put the quotation marks around it. What you're saying is correct, and I'm not disagreeing with what you're saying, because you're right. But the caveats around that is that dividends get cut in a recession.
Yep.
So, and this is one of the fallacies of dividend yield investing that a lot of investors have. Is like, oh, well, I just buy it for the dividend. I don't care about the price. I just want the dividend. Well, in both 2000 and 2008, dividends were cut by over 50%. A lot of companies just quit paying the dividend altogether. We saw the same thing in 2020. We saw a number of companies cut dividends to basically zero during the 2020.
You have to if you're trying to stave off bankruptcy, right? Exactly.
Correct. Absolutely. So my point is that there's nothing in the markets that are guaranteed. All of these strategies, and again, whether it's an income factory model or an S&P model or a bond model or a commodities model, it doesn't matter how you invest. They all have their basic performance profiles, but there is an immense amount of risk to every strategy. And so you just have to go into this understanding that without managing that risk and paying attention to what's going on, and just saying, oh, I don't care what happens because I just want the dividend yield, you may wake up one morning and have no dividend yield, or at least a 50% reduction in your yield, and have also lost 50 to 70% of your portfolio value. So now what are you going to do? Right?
Yeah. So for a couple of things. One, overarching message for not just this video, but all, right, is that it's all about risk management, right?
Absolutely.
You do the math, right.
Which is why you and I spend so much time talking about it.
Exactly. And if you're, if you don't feel qualified to do that as a DIY investor yourself, then find a good advisor who can play that role of risk manager for you, because that is the key thing that we're talking about, right? But let me be super reductive in this, which is, and I'm painting with a broad brush here, Lance, so I'm not trying to get you to say, oh, there's a magic silver bullet here. But let's take the Goldman Sachs forecast that just came out, right? Yep. 3% returns for the average returns for the next 10 years, right? So, and it's kind of surprising that Goldman is ringing that bell, right? But let's assume that's correct, and you think it's what's going to happen. It's a pretty good argument to say, well, gosh, I could just buy, a 10-year treasury right now, and that would be much safer than owning equities. And if it's true, and I lock in 4+% for the next 10 years, and the market only returns 3%, I've gotten a lot more yield for a lot less risk.
Problem is, psychologically, the investor will never last that long. And what I mean by that is that, so this goes right to the heart of the article that I just published on the website today, talking about lower forward returns or high probability event. And this is the chart you're talking about right here, which is and what Goldman's saying is that based on.
Do me a favor, can you increase the size of that? No, nobody can.
Here, I got a better chart of it right here. So what Goldman is saying, and this is actual returns versus the markets, that based on where we are valuation wise, forward returns are going to be somewhere between 0 and 3%, could be even negative. As we've talked about before, though, so this is the theory, right? Exactly what you're saying, Adam, is that, okay, great. Why even deal with that? I'm just going to go buy a 10-year treasury. I'm going to get 4% a year, and in 10 years, I'll be fine. And then we'll be on the next growth cycle in 10 years. Well, the problem ultimately is going to be that the investor doesn't live that long. Here's an example of what actually, when somebody says a 3% return in the market, they don't mean 3% every single year. You're going to have a 10% year, a 15% year, and then and so you go out and you buy all your treasuries today, as an example. And so I'm locked in. I got 4% and 3% coming for the next decade. I'm awesome. And then next year the market's up 10. The next year the market's up 15. Well, at this point you're going, well, damn it, I shouldn't have listened to Adam and Lance and went and bought those treasuries. Look how much I missed in the market. So you go sell your bonds and you buy stocks. Just at the beginning of the year, you get a 15% decline. Next year, though, the market's up 15. You're not back to even, by the way. 15, a negative 15 to positive 15 doesn't get back to even. But the next year you get 10. The next year you get 10. Markets are doing fantastic. Then you have a 20% down year, a 15% down year. These aren't incredibly big down years, by the way, historically speaking. These are rather normals to see. We had 20% down year in 2022, right? So 20% down years, plenty normal, historically speaking. 10 years, you get 10% gains for the last 2 years. Your average return is 3%. But you had 70% of the years you were making money in equities where you could have done better than just owning bonds. And this is why active management outperforms buy and hold investing. So again, let's look at this over time. Go back to the beginning. You go buy an S&P index ETF. I'm going to actively manage a portfolio. My job is to get 80% of the upside and capture 20% of the downside. At the end of this 10-year period, if I do my job versus you're going to get 3% average return. I'm going to be somewhere around 6.
Yeah.
Right. So that's why passive investing will outperform in a raging bull market like we've had over the last decade. And that's because of this. when the big question I think that we have to ask ourselves is, in order to suggest that we're going to continue to generate 10 to 15% annualized rates of return as we have over the last 14 years, can we do another $40.5 trillion in injections? This is HAMP, HARP, TARP, Maiden Lane, 2008. QE 1, 2, 3, 4, all that. I mean, all this stuff that we've done over the last 14 years has generated these near 14% rates of return, which are 50% above the long-term average. So, can we continue to do that in the future? Maybe. But if we just return to average rates of return relative to economic growth, your average rate of return, by the way, is, and you can calculate it yourself. So make your assumptions for economic growth, make your assumption for inflation going forward over the next decade, and make your assumption for dividends over the next decade. So if you assume 2% economic growth, 2% inflation, and 2% dividends, you've got a 4% return in the market. You subtract the inflation from dividends and growth. So if we go from 14% to even 6%, it's going to feel like a really disappointing market over the next decade. You're going to like, what the hell's going on, right? So because we're so used to these outsized returns, but they're not sustainable long-term.
I was getting dinged because I think I made this analogy first with you, and I was making it again recently, and someone was like, "Boy, Adam is really trying hard to make this analogy work." But it's the sports team, right? It's your football team that's won the Super Bowl the past 2 years. even if you make the playoffs in year three, you're disappointed because you didn't three-peat. But it's like, come on, man, what were the odds of getting a three-peat? Like infinitesimally low, but you got so spoiled, you just gave a far too outsized, probability of it in your mind because you feel like your team's unstoppable, right?
Right. Yeah. No, I mean, I
You're
remember the
thrilled.
Steelers.
You won the division,
Yeah.
but you're bummed because they didn't win the Super Bowl for the third time in a row.
Yeah,
Yeah.
yeah. I mean, I remember the Steelers when I was growing up, with Mean Joe Green and Swan and Lynn Swan and all those guys. I mean, it was like an unstoppable, unbeatable team. Nobody's ever going to do this again. And then, then it ended. Those all dynasties end at some point or another for one reason. But valuations are a problem. If we just a quick glance, this is, two things, real quick, two things about valuations. First of all, do not ever manage your portfolio based on valuations.
Terrible timing indicators. Yep.
Yeah. Yeah. So in the short term, a year to two, valuations are nothing more than a big confidence indicator. This is consumer confidence versus the trailing PE ratio. So you can see there's a very high correlation between the two. This goes back to 1985. So in the short term, valuations are nothing more than investor confidence, right? So I'm willing to overpay. I think this market is just going to keep going up forever. So I'm willing to overpay for earnings. So in the long term, valuations tell you everything you need to know about earnings and returns, but that's 10 to 20 years. And again, we have to navigate markets for what we have in the short term. And so we have to manage for this year. We've got to manage for next year. We have to manage for the year after that. Valuations can tell us that we're going to move into a period of higher volatility, and that means that we're going to have more markets that are up and down from one year to the next. It's going to be a much more challenging environment.
Which is why, sorry to interrupt, but I just want to underscore, which is why an active approach will likely be the superior one going forward. And just so you know, Lance, I echo that all the time. So I'm right on the page. I literally gave my diatribe about active investing versus passive investing yesterday at this investor conference. So I just want to underscore for folks like the reasons why, you're saying that, which is, if you expect future volatility, you're going to have years just like the chart you showed earlier. And if you're able to, this is the wrong word to use, but if you're able to surf that intelligently the way that an active investor can, you're going to likely do much better over that same period of time than a buy and hold strategy.
Yeah, exactly. And look, and valuations are very deviated from long-term means. You're going to get a reversal. It's just valuations are above what economic growth can generate. And so, we're going to have this reversion at some point. And we'll have to deal with it. And we'll go through it, and the bears will eventually have their day where they say, "See, I was right." But that's going to be an awesome investing opportunity. I can't wait for it to happen because we'll have an opportunity to buy some great companies at great prices and really make a lot of money over the next period. The next 20 years following that period will be just fantastic. I'll probably be dead, but that'll be great for investors.
Can I just build on that on a potential catalyst for that?
Sure.
Okay. So yeah, I'm just going to turn your chart off for a second.
Okay. Let me do
it. So for those that didn't see it, last week I interviewed Michael Howell, right? And Michael Howell, very smart guy, started his career at Salomon Brothers, which was a factory of a lot of great traders and investors. And Michael's big focus is liquidity, right? And Lance, many times you and I have talked about, gosh, maybe at the end of the day, maybe we should just ignore all the other noise and just look at net liquidity flows. And that's probably more likely to tell the story of what's going to happen. And Michael has, he's got this chart of these liquidity cycles, and history shows, at least the way that Michael measures liquidity, that it does happen in these cycles that are multi-year cycles. And for a whole variety of reasons, he became one of the earliest bulls at the end of 2022 because his indicators showed that net liquidity flipped from negative, which was an important explanatory factor of why 2022 was such a terrible year, right? And in October of 2022, his model showed that net liquidity had reversed and was now positive. And he rang the bell back then saying, look, I'm bullish for these reasons. Lo and behold, October 2022 is when the market bottomed. He remained very bullish ever since. and still is to this day. And if you look at his model, the peak of this current cycle isn't until the end of next year. So we still have a year in theory of rising liquidity in the system, which is why he says, I actually think, financial assets are still going to power higher from here for a decent while. But he's a lot more tempered going into 2022 for two reasons, one small, one big. At the end of a cycle, as you get near the peak, the impulse of the net liquidity inflows slows. It's like throwing a ball up in the air, right? The closer the ball gets to its apex, it starts slowing down. But much more importantly, he said, look, we have this massive corporate debt refinancings wave that's really going to get kicked off in earnest, or it's really going to start hitting, critical mass next year. So as we go through 2025, that is going to act like a sponge starting to suck liquidity out of the system, right? So you kind of have this twofold factor where you have the end of the natural liquidity cycle, plus this additional event that is acting, kind of exacerbating the extraction of liquidity. And so he said, I think 2025 is going to be a disappointing year for investors. He's not calling for negative returns, but to your point, Lance, we've gotten so used to this massive, tailwind at our backs. He's like, that tailwind's going to start sputtering out. And so we're going to be disappointed with the returns that we get. And then he said, going into 2026, obviously he wants to come back on and update us as we get closer, but he's like, to me, that's looking like it's going to be ugly. And so, pardon me?
And it's a very good point. It's a very good point you're making. And this is why interest rates are going to go lower in the future, because when that debt wall maturity hits the banks, which are the ones holding the loans, these debts just don't hang out there in the middle of nowhere. The banks own these loans with these companies. And so when that debt maturity has to be done, if interest rates are very elevated, the Fed is going to be working to lower those borrowing costs to sustain and stabilize the financial system, particularly within the banks, to potentially, forestall or delay any type of issue that might lead to a repeat of the financial crisis. The Fed learned a big lesson during the financial crisis. They will not do that again.
Yeah. Well, and it'll be interesting because the Fed's reputation is always being late to the game. So I don't doubt what you just said would happen, Lance, but I do think you can have an intelligent debate as to the Fed will pre-position in front of it and help, shock absorb all this, or if we're going to have to get to some, level of pain that'll.
I think it was interesting this morning. I put this out on Twitter because the GavCal came out with this piece of analysis, and it's really interesting because it's not really accurate. It says U.S. bond yields will never return to their post 2008 trading range. What he's saying is that yields are now permanently higher, but it only goes back to 2002. And so this isn't a great piece of analysis relative to what's actually been happening in the economy. So, if we look at, this is an economic composite. So as we've said before, yields track inflation and economic growth. Why? Because yields are a function of the return received on investment from a fixed maturity debt instrument. So as a bond issuer, if I'm loaning money to Adam, then I've got to make sure that my rate of return is above the rate of inflation and above the rate of economic growth, opportunity cost. And I've got to factor in credit risk and all these other things. So if the long-term trend of inflation and economic growth is returning to normal, and that's that curved red line that we have, and everybody says, well, it's the debts and the deficits, we're never going to have low inflation, low economic growth again. Well, that's not really true either, because this is the deficit. The reason that we've had a pickup in yields is because we've had a big reduction in the deficit relative to GDP. So as we have the deficit declining, that's led to higher yields because you've had more economic activity. But as the deficit does increase, that is disinflationary, it's deflationary. And if you begin to have higher yields that impact the financial institution, and I agree with you that the Fed will be late to the game, that means the Fed will be back into panic cutting mode to try to stabilize the banks as we start having corporate failures. And that's going to drive rates towards, the Fed funds rate will drive back towards zero, even though Jerome Powell said, we're not ever going back there again. I call bullshit on you, because when you get in a financial crisis, you're going to be at zero again. And the long-term treasury yields can be somewhere around 1%.
Yeah. Okay. Very plausible. Again, I just want to reiterate why I kind of brought this up, was you were saying, hey, I don't know when this thing's going to happen, but I can't wait to get into at lower valuations. This could be a catalyst for that, right?
Absolutely.
Yeah. And then of course you would jump in, and then if the Fed really has to ride to the rescue, so it's not just bringing rates down, but it's I'm injecting all this stuff to get the economy juice. That will be rocket fuel at the back of your.
Absolutely. And again, at that point, I won't want to own bonds anymore, because they'll be fully priced. We'll be at a terminal rate for, and again, the bond trade ends when we get to a terminal rate. So when we get to the terminal rate, and that's where rates are equal to where they should be, when we get to terminal rate, you'll sell bonds and you'll buy equities, because equities will be heavily discounted. So you'll shift from a 60-40 allocation to 80-20. And your 20% in some bonds will be in distressed debt, corporate high yield, et cetera, of companies that, typically what happens, like during the financial crisis, we assume ExxonMobil is going out of business. So they deeply discount ExxonMobil bonds. But those are the companies you're going to be looking for to buy. You'll buy broken convertibles, you buy high yield, you'll buy things that, are good, fundamentally sound companies that are just distressed in price because of what's going on in the overlying bond market. So that'll be 20% of your portfolio. The other 80% will be high value, high quality dividend paying companies that will yield you a very nice return over the next 10 to 20 years. But again, that's not next year. That's not the year after, most likely. It might be 5 years from now. Who knows?
Who knows? But you have your playbook in place for.
Absolutely.
Yeah. Okay. And I just want to note, Lance, every week I'm going to give you a chance to update us on how you see things unfolding, especially in bonds. I do just want to note that, I talk to a lot of people. That's my day job. And right now, I would say on most issues, there's kind of a general consensus of the folks that I talk to. But in the past 3-4 months, it's almost 50-50 differential of opinion on where bonds/inflation are headed. And this is one of those instances where very smart people can look at the same data and come to very different conclusions. So as cool as a cucumber, as I would say you and Mike Leibowitz are on the bond trade and where you think things are headed, there are some other people that have very different perspectives. Sure. It's going to be fascinating to see which win out here. And folks, this is why we have markets, right? People have difference of opinions and they trade based on that. And someone buy at a price or sell at that price, right? So it's going to be really interesting to see where this one comes out, both intellectually. I'm just curious, okay, who's right? Because you can hear compelling arguments on both sides. But more importantly, what happens with interest rates is going to determine everything. So like we have a lot.
Yeah. Well, and again, it also depends on time frame. So as we've talked about before, when you talk to people, the question you should always ask is, okay, I hear your prediction. This is awesome. You think interest rates are going up. When? What's the catalyst? And what's the result, right? What's the opportunity? Because if you can make forecasts all day long, interest rates are going to the moon. Great. That tells me nothing as an investor. Just tells me interest rates are going up. There's tons of ways to capitalize on interest rates going up, but I've got to know, when is it going to happen? How is it going to happen? What's the driver and what's the opportunity? And so, and this is why we're always very cautious, with when we tell you stuff here, is like saying, hey, right now the market's overbought. We think over the short term, the next month or 2 months or 3 months, there's some downside risk. We might have a correction. Over the next 3 months, we've got potential for upside because of these specific factors. Our bond trade is based on longer term time frames where we're looking for opportunities that are 2 to 3 years out. So we're looking 18 to 24 months, somewhere in there, for this trade to play itself out. If it doesn't, then we're going to have to either adjust our position or do something different, right? So it's very important to have time frames. The problem with most of the people predicting that interest rates and inflation are going up is they say it's because of the debt or it's because of the deficit. There is no historical evidence that higher debts and higher deficits lead to inflation or economic growth. It is the opposite. It is because debt diverts productive assets into debt service, it leads to slower economic growth because you have less money going into productive assets.
Right.
So
It's
because you had to make interest
kind
payments.
of negative
Yeah.
debt multiplier. Right. You get
Negative multiplier.
where more debt doesn't stimulate growth, it actually steals from it. Yeah.
Right. So most of the arguments, I'm not saying all of them, but most of the arguments for higher rates, commodity cycles, all those type of things are based on a faulty underpinning. And that's where you've got to get back to the basics of economics and data.
Okay. But this is where I get to that quote I've been saying a lot recently, which is if you're not confused, you're not paying attention, which is you're right, which is right now there are very smart people looking at the same data and making different conclusions to it. So anyways, all right, we got to start wrapping up here, Lance. One point I just want to mention is we have this K-shaped recovery where it's been the top 20% doing the heavy lifting, keeping the averages high or at least looking okay for things like retail sales and stuff like that. But we are beginning to see cracks in the short end of the K, where the rich spenders are. LVMH, which is a big luxury brand, has seen a lot of drop off in sales of a lot of its big brands like Rolex and high-end items and whatnot. And then Polaris, we've talked about the RV indicator, right, where the RV is like the ultimate toy, and we've seen the RV companies, get into tough times over the past year and a half now. Polaris, they just hit their earnings. They announced their sales are down almost a quarter year over year. And they sell ATVs and jet skis, and specifically cited challenging retail demand. So, we're at the point in the story here where the toys that everybody buys when times are good and they're feeling confident about the future, things have reversed. They're not buying them now. They're dumping them. Right. So just an indicator of where we are. Right.
Same thing to building pools. If you take a look at Pool, P-O-O-L, they're a big pool builder. They've been reporting weak demand, those type of things as well. I am very fascinated. So next week, we get into really a big chunk of earnings, the next 2 weeks, but next week, by the end of next week, we'll have about 80%-ish of all corporate earnings coming in. Next week's Apple, Microsoft, Google, all the big boys. I'm really anxious to see the Walmarts, the Targets, and the retailers. There's been quite a bit of conversation of more consumers shifting down. And again, you saw this with like LVMH and others. You're seeing all of a sudden, we call it bougie broke. We're starting to see people go, hey, I'm bougie. I shop at Walmart, and they're buying name brand tags, off of Walmart shelf. We're starting to see more of that trend. So, and so I'm really anxious to see what the retailers say, particularly heading into shopping season, because again, we've got Halloween, which, by the way, if you didn't know, is the second biggest shopping retail period of the year. Everybody's buying costumes and candy. But then we've got Thanksgiving, Black Friday, which started 4 months ago. I remember when Black Friday was actually Black Friday, and now it starts on Monday or whatever, like 3 weeks ahead of time. It's Black Friday sales. So we all count them as 1 day sales, even though it took 3 weeks to get there. But it's very interesting to see that. We're going to get a lot of data from companies like Adobe, which are these kind of retailer organizations. So they're always super optimistic. Like, oh, retailers are going to make, they're the marketing arm for retailers. We're going to have $9 billion of sales on Black Friday, whatever it is. Those numbers always typically miss. So it'll be interesting to see just how far they off this year.
Okay. Yeah. Well, we'll report on those, next week after when we get the data. I don't want to get into this now, but I just want to put a little flag here in case it turns out to be more correct. At the conference last weekend, Fred Hickey, publisher of the High Tech Newsletter, kind of dialed through his, increasing skepticism of at least near-term return that we're seeing on generative AI and the risk to capital spending in that sector. If purchasing managers and technology start to say, look, I just can't keep spending like this without seeing some kind of direct monetizable return on it. And he said, look, there's decent probabilities, not saying it's an eventuality, but there's decent probability that we could see some disappointments from these big, mega scalers in the big Mag 7 companies that have benefited so much from this. So he's watching this really closely, and again, in a week or two, we'll have the results of that, and we'll see whether that concern was justified this quarter or not. All right, so Lance, if we can, let's get to the trades that you made over the past week.
We previously made trades. We were expecting this little bit of a correction kind of pre-election to start with. And we've kind of been through those trades, and we trimmed energy. It had a big run up.
Yeah,
and we were expecting a decline in oil prices.
The probability of a pullback. That was, I think, the title of last week's video. So that makes sense. Yeah.
Yeah. So we've kind of already done that hedging. We have a portfolio that we run. It's called an all-weather model. And it's got basically about 8 to 9%. I don't know exactly because it's grown this year, so I haven't actually measured it. But we have about an 8 to 9% position in gold in that. Gold is real quick. Let me just share a couple. I was doing some work this morning. That's why I was when I showed you that one chart, which was on gold. I was doing that work. Gold has right now been up a very extended period of time above its 200-day moving average. Now, normally, historically speaking, stocks are the same way. So when you have a tradable asset, and again, gold is just traded on the futures market, so it's just people buying and selling. So the same thing for stocks. So when things trade above their long-term moving average for a long period of time, that moving average is like gravity. Eventually, the price has to trade below that at some point. So if you take a look at that kind of picture, and then take a look at the fact it's had just a fantastic return this year, and then take a look at, basically you've had just the largest inflows into gold this year since 2020. Really 2021, when we gave people all their money and we had this big pop in inflation. So you have this massive surge, this inflow into gold. And then you take a look at the second red line is July.
Hey, we're not seeing this chart. So
I'm sorry. My apologies. I've been showing you all these great charts, and here's the inflows into gold this year. So it's the largest since basically 2020, 2021. And if you take a look at this chart, so this red line is June of 2021. So that was the peak in gold. You had a very overbought condition on a monthly basis. You had these massive inflows. Your correlation of gold to stocks is near 1 at that point. And so here you are again, same type of relative strength overbought. You've had an extremely long duration above the 200-day moving average. Your correlation to stocks is 0.93. So basically what all this means is you just have everybody chasing every asset class at once. So we've got this, we're probably going to trim back and just reduce our normal target weight in that portfolio is around 7%. So we'll probably trim that back this week, just take some profits. The deviation is getting pretty extreme here. So you should probably expect some type of corrective action over the next several months in gold, just to kind of normalize kind of some of its trend. So just a pullback to the 200-day moving average, a pullback to this kind of rising trend line, it could be fairly substantial. If you pull back to this rising trend line, you're talking about 2,100 on gold from 27. So you could potentially see about a $600, $650 pullback in gold prices, and that would still be bullish. It would be a great buying opportunity, but it's just getting pretty deviated. So we're probably going to take profits in that portfolio sometime maybe in the next week or two.
Okay. But nothing else since last week?
No, everything else is pretty well positioned. We added to NVIDIA when Stanley Druckenmiller came out and was talking about, he didn't like NVIDIA because he didn't think they were going to make earnings, things like that. We bought more NVIDIA. That's done very well for us. We think they're probably going to kill it on earnings this year. They report earnings in November. They cannot keep up with demand right now for their Blackwell chip. So we're still long our NVIDIA positions. We had added to it. We trimmed it back in July. We added to it in August. We're still long our AMD position as well. We think it's well positioned for the AI market. And then we've diversified our portfolio across more conventional assets, good dividend paying companies. We've added utilities and real estate earlier this year that have just gone gangbusters. So it's been a really good year for the portfolio. I don't expect that to continue, but it's been an easy year to manage money for sure.
Okay. All right. Well, I'm sure your clients are happy with that. All right. Well, look, just in wrapping up here, we'll just take a minute or two. I wanted to reflect briefly on what we talked about at the very beginning, which is that so often in history, one of the things that fascinates me about it is so many like momentous developments in history often come down to just a small number of people, and oftentimes a small number of people who where things were just super uncertain, right? Like they could have, history could have gone, completely differently if just, one guy didn't show up at the right time or some fluke hadn't happened. So I mentioned that we took this walking tour of the tavern where the colonists basically came to the decision that, you know what, we've hit our point of we're just not going to take it anymore with all these taxes and limitations that the crown is placing upon us, and we're going to build our own secret militia, right? So this was guys like John Hancock and Sam Adams, right? They came out here to Concord because if they were going to get they were like definitely on the crown's most wanted list in Boston, and so they had to come out here to plot. The tavern room that they planned all this with all the other guys that were in on it was like no bigger than this room you see me in here, which is really small, right? Um, and so again, just a very small number of people basically are the reason that we have this independent nation right now, right? And what was so interesting is, and we've heard about this, is like back then they say, there's about a third of colonists who were like, who got on the train of like, yeah, we need to push back against the crown. There were a third who were Tories. They saw themselves as British citizens and they didn't want to rock the boat, and they didn't feel like that, this was the right thing to do, right? Like very divided nation. Then you had about a third who were just like, look, I just want to like farm and feed my family, like just leave me alone, right? So it really was a minority of colonists that drove the change that we had. It wasn't like every American was on this board. You had, neighbor versus neighbor, sometimes brother versus brother. I mean, it was a highly divided, highly uncertain a mix going on here. And then there were things like, the famous one if by land, two if by sea, signal that sent Paul Revere and his other cohort, I'm blanking on his name, to go out and warn the countryside that the British were marching on Lexington and Concord. And one of the things that I learned I didn't know is there was a guy from Concord who wanted to get home to Concord, who kind of hitched a ride with Paul Revere and his cohort. And along the way, they got to a point where Revere and his cohort couldn't continue because the British were there, and they were going to get nabbed because the British were looking out for them. So they sent this other guy, I think his last name was Prescott, ahead to basically just tell the British, hey, I'm just trying to get home, right? And they let him back to Concord, and he ends up in Concord and tells everybody, hey, the British are coming. So he's the guy that actually delivered the message to all the colonists that were storing all the militia and everything. And so if he hadn't gotten through, the folks at Concord would have been caught by surprise. This whole thing would have been over before it started, right? But it just happened that this guy decided to kind of hitch a ride with Paul Revere at this time, right? It's just things like that where history could have gone, the revolution could have been over before it even started, right?
Right.
One other fun story was when the British showed up in Concord, all the men had grabbed their gear and they were at this place called Northbridge. So when the British came into town, it was just women and children, right? And the British overwhelmed the town. They started going door to door, and a huge part of what made the difference was, in a lot of cases, the women would come up with these reasons why the British were told to search the houses, right? Because they knew stuff was being stored. And the women would say things like, oh, no, my teenage daughter's in that room. You can't go in there. And the British soldiers would say, okay, well, I guess we won't, right? And of course, the room is like just stacked from floor to ceiling, with munitions and stuff like that. So, the everybody had a role to play in how this thing ended up, right? So it's so fascinating to look at the scope of history through that. if not for the persistence of just a very few people in a lot of these cases, who knows? America would be British's biggest holding right now, right? What I've taken away from this is like the times in our own lives, right, where like the outcome looks uncertain. Um, we're just like, look, I don't know if, but I've got this goal today. The path towards that goal just looks really unclear, right? And sometimes it's just the persistence that makes all the difference in the world, that you just keep yourself in the game, right? And I'm sure, in if anyone who studied Revolutionary War history knows that, not just the places I talked about, but like, Manhattan, right? The battle for New York. Basically, Washington had to basically turn tail and get his guys out of Manhattan when the British showed up there. And there were so many opportunities where if the British had caught him there, again, war would have been over, right?
Yeah.
America wouldn't exist. So, in our own lives, like sometimes it's just dark, it's uncertain. We feel like, I don't know, am I just wasting my efforts or not? And the difference that makes is just, do you keep your nose to the grindstone and keep pushing along and provide the opportunity for a better day to happen tomorrow, for good luck to all of a sudden open a door for you, right? And I guess the parting sentiment I have is like, if you're in doubt about it pursuing a goal, if you capitulate to that, you just say, you know what, it's I don't know, I don't know what I'm doing. I should probably just stop. That guarantees you're not going to meet your goal. Right? As long as you have grit, you keep persistence, you're like, look, I don't necessarily see the direct path yet, but I'm going to have faith that if I keep working, a door is going to open. You at least have the probability of that happening. And so many times in your life, advancement is just dependent upon you just closing your eyes, keeping your head down, and just persisting.
Yeah, it's funny. I started a Twitter war this morning because I posted this tweet, and I've discussed how I handle things with my kids, and this is just how I do things in our family, and it was just interesting because there was a chart out this morning. It says, which of the following factors influence your decision to open a 529 plan? And the chart was basically 86% of people said financial security for my kids' education, tax advantages, flexibility and usage of funds, ability to roll over funds to an IRA. So I wrote on this Twitter, I said, here's my personal view of 529 plans. F them kids. I paid for 18 years of your life. Welcome to adulthood. And I put a smiley face. I said, look, I'm kidding. I said, I think 529 plans are great if you want to pay for your kids' college. I said, personally, my kids pay for their own car, college, and insurance. You'd be amazed at how much more serious they take college when they are footing their own bill. I'm going to get to your point in a second. If they graduate with a strong degree, now my kids don't know this part. If they graduate with a strong degree, get a decent job, and become good citizens, I will help them pay off their student loans. It's kind of a bit of a carrot and stick process to help them make better choices. And so I got all this pushback, of course, and it was like, no, the parent's job should make things easier, but that's the parent's job. They should handle the bulk of the strain. And to your point, see, I disagree with that, and I wasn't raised that way. My dad literally taught me to swim by throwing me into the deep end of the swimming pool. That's how you learn to swim when you were growing up in the 70s, right? And there was never, hey, here's allowance. Who the hell gets allowance? You went out and mowed yards, washed cars, you did whatever you could to make money.
Right. My last name's not Rockefeller.
Yeah. And and so that's the way it was. And so I've never believed in soft parenting. I'm more of a throw them in the pool, let them swim type of person. And I answered that back. I said, I don't disagree with you, but I don't do soft parenting. Strain builds characters, hard times build hard men and women. And to your point, we forget that the people that came here and founded this country and did the things they did, they committed treason. Everything they did was punishable by death. So if anything didn't go the way that it went, if we had lost battles, to your point, right, just a small change in Manhattan or in any of the other battles that were fought, crossing the Delaware, if any of those had changed, we wouldn't have this country today. They would all be dead. Right. but they were willing to face that hard choice, that hard difficult, and then see it through. They didn't, they didn't halfway through go, oh, this is really too tough. I tell you what, y'all, just y'all come over here and
you guys forget about it. Yeah,
yeah. Let's be friends. And
we do a do-over.
This is going to be the UK of America now, right? And that didn't happen. They had to see it through because there was no choice. And you died if you didn't see it through. Now, obviously, we don't have to make those choices any longer, but I do agree with you that if you're going to be successful, I can someday we'll have to sit down and just talk about all the crap I've gone through for the last 40 years building businesses, and the lawsuits, and the legal challenges, and the financial hurdles, and all those type of things. Any one of those things, trust me, there were so many times that I just get up in the morning and go, I just want to screw it, right? Just quit. Just stop. I'm just going to go get a job and work 9 to 5. That would be I used to envy people like that. I would just like, it must be so nice not to have to worry about things. And
getting a guaranteed paycheck every 2 weeks.
You just get a paycheck and it's all good. And even today, I mean, our business is very successful now, and I'm very grateful for that. It only took 30 years to get here, but hey, it's working great. But even today, it's not a risk-free adventure. We just had a budget meeting yesterday, and when we're doing our budgets, we calculated, man, if we have a 40% decline next year, we can't get paid. We have to pay our employees. We have to pay our rent.
Get rid of that champagne fountain in the lobby. Yeah, that might need to come out. Yeah.
Yeah. We've got to pay all these. We can't just not pay people. We've got to pay employees their wages, their salaries, their bonuses, their healthcare benefits, and all those type of things. We're the ones that don't get paid. And this is the thing that people misunderstand when they talk about taxing the rich. You have to remember, the rich, the people that own businesses, they're the ones that took all the risk, and they're still taking that risk. If something goes wrong, it's on them. It's not on the employees. All right. And so if you're going to go into business, if you've got a goal, whatever it is, you've got to be willing to take on that risk of failure and persevere through it. And you've got to have the attitude is that I'm going to do this, even if it kills me. And if you have that attitude, you can't help but be successful if you're willing to die to do it.
Right. Or at the very least, you can't help but be more successful than you are today, right? You might not hit your total goal, but
Well, yeah, my goal was to be a multi-billionaire like, Jeff Bezos. I'm not going to get there. But
I think this is a line from Cyrano de Bergerac, but it's like, if you reach for the stars, you're not going to end up in the mud, right?
Yeah, exactly.
We're between here and the stars, right?
Sure, absolutely.
And so agree with everything you said. Again, it had me reflecting on, all the challenges of even today, of still being a solopreneur, right, with thoughtful money. But it did also give me a sense of like, it put it all in perspective. There are definitely things that will wake me up at night, challenges, business challenges that need to be resolved, things like that. But I'm like, hey, but at least I don't have a sovereign nation coming after me to kill me. These guys did here, because here, literally, in that chapter, that's where they made the decision to say, look, it's going to be treason. Like, we realized that by taking this next step, we're now officially, dead men walking to the crown, which was the biggest superpower of its day, right? So the immense amount of courage that it took for those guys to do that, and what they had to do to see that through, then makes our personal business issues like, what do I have to complain about, right? Worst thing that happens is it doesn't go the way that I think it's going to, right?
Yeah. And mind you, they weren't just facing, a simple death. Back then, the punishments by death for being a traitor were pretty gruesome in a lot of cases. So it wasn't just simple, death by lethal injection or electric chair. They were far worse.
Yeah, no, we were actually talking about that yesterday, the famous Ben Franklin thing, like, we all better hang together or else we're for sure going to hang separately. But it was like, it's not going to be like a nice quick hanging. Like, I mean, we're really, if we lose here, like, we are really going to regret that we ever did this.
Yep. Yeah. No, it is. And you have to admire them for that. I mean, they literally put it all on the line. And I think, this is the thing that saddens me, particularly with a lot of the political rhetoric that's running around right now about, we're a democracy, and because we're not a democracy, and we're a republic, and it's just the function that so many people today have no sense of history. They either weren't taught it, they didn't pay attention to it, whatever it was, but they don't realize what went into the founding of the country and what was put on the line, and what's embedded in that constitutional document, and the Declaration of Independence as well. And we've forgotten that the reason it's written the way that it's written is because they wanted to try to ensure that we never went back to doing what they left to start with. And unfortunately, slowly for the last 50 years, we've been slowly migrating back, taxation without representation, all these things that they wanted to avoid have slowly been creeping back in as we allow government to get bigger and bigger and bigger and more controlling and more overreaching into our daily lives. That was what they were trying to avoid when they structured the Constitution. And this is why so many conservative politicians, et cetera, want to return back to the Constitution and follow what its doctrine set out, was to avoid exactly what's going to happen.
Well, I tell you, my time here has really given me a deep sense of appreciation and gratitude for what those courageous people back then put in motion. And as you said, we owe so much to them. And so, anyways, I'm taking a lot of inspiration from it, and hopefully, viewers here hopefully are doing a little bit of the same.
Yeah.
Maybe they brush up a little bit on their history because we've triggered an interest or whatnot. But anyways, you look back and you just say, gosh, we need a little bit more of that mettle, METTLE, in our society today, and I'm going to try to carry a little bit more of it forward from here as a result of my time and the inspiration here. Anyways, if what inspires you truly to live a better life is listening to Lance Roberts on this channel week after week, let him know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you'd like some help putting into practice any of the investing strategies that Lance talked about here, highly recommend you do that working under the guidance of a good professional financial advisor. And again, if you'd like some help directly from one, then encourage you to consider scheduling a free consultation with one of the advisors that Thoughtful Money endorses, perhaps Lance and his team there at Real Investment Advice. To do that, just fill out the short form at thoughtfulmoney.com. Lastly, if you didn't make our conference last weekend, but would like to still watch and enjoy the whole thing, good news is you can purchase the replay. To do that, just go to thoughtfulmoney.com/conference. And if you are a premium subscriber to our Substack, remember you get a $50 discount off of that. Lance, my friend, as usual, I'm going to let you have the last word.
Nope. Y'all have a great weekend and enjoy being here. And then we'll see what happens next week, but don't be surprised with a little bit more volatility up and down.
All right. Thanks so much, buddy. Everybody else, thanks so much for watching.